So let's have a look at the market and what's happening out there. It's pretty apparent. So these are April figures. So these results were published 30th of April. So this is to April. And of course, there is quite significant differences in the market, the way things are happening. Sydney for the month has shown a negative 0.2% deficit. And the quarter, they're now showing a 0.5% negative growth rate. So that's the first time that we've seen Sydney and Melbourne go into negative growth rates for the quarter. Before that, it was just the month. Now we're seeing negative growth rates for Sydney and Melbourne in the quarter. So that's obviously interesting because it means that there is a definite downward sort of trend in the major cities being Sydney and Melbourne. But nothing to be too alarmed about because their annual growth is still represented at 14.7 for Sydney, 8.4 for Melbourne. But we are, once those, the months continue and those negative growth rates start to show up, in the second quarter and the third quarter, we're going to start seeing those annual growth rates drop sharply. So I think it's fair to say with Sydney and Melbourne leading the way that that the downturn is imminent, but only Sydney and Melbourne are experiencing it at the moment. So if you're not in Sydney and Melbourne, ignore it, put it out of your head. And when your sellers and when your buyers especially start saying, "Oh, but the market's dropping," say, "Sorry, it's only in Sydney and Melbourne. The rest of the country, for that matter, is going great guns." And let's have a look at the rest of the country. So Brisbane, 1.7% growth for the month. That's massive. Adelaide, 1.9%. That's massive. Perth, 1.1% growth. That's massive. Hobart also showed a negative, which I just want to mention. We don't talk too much about the Hobartians, but they also showed a negative growth rate of 0.3% for the month, which was interesting. Darwin have dropped sharply to a positive of 0.9. Canberra, positive 1.3, which is massive. So let's have a look at Brisbane, Adelaide, Perth. Brisbane, 5.7 for the quarter growth. Adelaide, 5.4 growth. And Perth, 2.4% for the quarter growth. All right, so annual return, Brisbane insane, 29.3, Adelaide, 26.2. Perth is only 6.7. So obviously we've lost some of those bigger growth rates, now moving into another sort of 12-year cycle, but that should increase considerably. And then, of course, regional is actually dropping. So if you're in regional areas, regional is 1.4, 4.7 for the quarter, 23.9. That is definitely down on what it was previously. Capital cities is also showing modest growth because of the two-speed market, with the major cities being Brisbane, Adelaide, Perth, and Melbourne and Sydney, kind of showing differences in their growth patterns. So capital cities, 0.31 and 14.6% growth. Nationally, we're looking at 0.6% growth for the month, which is quite modest, and 1.9, which is very good for the quarter, still showing a 16.7% growth nationally annually. So still showing an upturn, but certainly Sydney, Melbourne are weighing down the stats there nationally. But regionally, I was pretty surprised to see how regional was showing some sharp declines as well, but not in the negatives yet, but certainly in the sharp declines. Let's have a look what CoreLogic have to say. The value index continues to lose steam as the case for higher interest rates amount. Have the interest rates been raised this morning? I don't think we've. So they have gone up. It was my birthday, so I didn't give a rat's about any interest rates or anything like that, but they have already increased. And I think that's a sign of the times. We should start seeing some more significant interest rates increases over the next couple of years. I'm just sucking a lozenge if you're wondering. Okay, the residential property markets of Australia, two largest cities, have hit the first quarter of negative territory since the extended lockdowns of 2020. Sydney and Melbourne market slowdown has seen CoreLogic national home values, HVI, continue to lose steam. Through April, housing values are still rising at a national level. However, the 0.6% monthly rate of growth is the lowest reading since October 2020. Okay. Sydney and Melbourne, which have the heaviest weighing on the HVI, were the main drag on the headline growth rates. Tim Lawless says the weakening state of the market has taken the rolling quarter trend into negative territory across Sydney and Melbourne for the first time since these cities were in midst of extended lockdowns in 2020. Diversity in housing conditions across the board, across the broad regions of Australia, half of the capital cities are still recording a monthly growth rate above 1%. Adelaide 1.9 growth in April, Brisbane 1.7, Canberra 1.3, and Perth 1.1. Although monthly growth rates remain high in these markets, Mr. Lawless warns the trend rate of growing is easing in most of these areas as well. Perth and Darwin are the exceptions where the rolling quarter trend has gathered some steam since late last year. Perth housing values were up 2.4% over 3 months ending April, compared with a recent lull through late last year when the quarterly trends fell to just 0.4%. A rebound in migration rates as state and international borders reopened could partially explain the renewed exuberance, along with persistent low advertising stock levels and strong economic conditions. That's Perth. While ABS international migration data by greater capital cities currently only reported in June 2021, the data points to a vast uplift in internal migration to Perth for the year, which is 6,468 new people coming to live in Perth. I predicted about 10 plus thousand, so I wasn't too far off. 6,468 new people coming to Perth, and that's before the June 21 stats have been released, which will tell us a much clearer idea of what the migration and immigration status of Western Australia or Perth is. A substantial turnaround from the previous 4-year average of negative 3,735. So if you add that together, it probably is more increased more than nearly 10,000 people. So that's quite huge for Perthians. Regional Australian housing markets have been somewhat insulated from the slowdown. Advertised stock levels remain 42% below the previous 5-year average in the regions, while the volume of home sales is holding 20% above the previous 5-year average. So this is regional, folks. However, the trend rate for growth is generally slowing as affordability constraints become more challenging. National reading dropping from a recent peak of 22.2% growth over the year ending November 2021 to 16.7% over the most recent 12-month period. Okay, so with the RBA cash rate set to rise potential as early as tomorrow, this was obviously printed before, we are likely to see the further loss of momentum in housing conditions over the remainder of the year and into 2023, Mr. Lawless tells us. Inventory, let's have a look at how the stock is faring across the country. Persistent low levels of property listings help to explain the strength across the smaller capitals and regional markets. Advertised inventory at a national level is tracking almost 30% below the 5-year average over the 4 weeks ending April 24 at a national level. Okay, so it's still below 5-year average. Each capital city highlights significant differences in total number of homes available to purchase. Total advertised inventory is more than 20% below levels from a year ago in Brisbane and Adelaide. So again, 40% lower to the previous 5-year average in both cities. In weaker markets like Melbourne, Sydney, advertised supply levels have normalized. Sydney advertising stock levels are roughly in line with the previous 5-year average. So there you can see the differences quite substantially between stock and inventory supplies. Listings in Melbourne were 8.2% higher than the 5-year average. So yeah, we can see that the market is certainly turning, drop in buyer demand. With higher inventory levels and less competition, buyers are gradually moving back into the driver's seat. That means more time to deliberate on their purchases and negotiating price. Softening buyer demand can be seen in fewer home sales. Let's have a look at the rental market. So the rental market are also showing multi-speed conditions of the capital cities experiencing upward trend in the rental growth in 2022. Quite interesting what's happening in the rental market. Based on the annual change, house rents are plus 9.1 and rising faster than unit rents of plus 8.7. However, this trend is changing sharply as demand for unit rentals increases. The shift in rental demand towards units reflects both rental affordability pressures. Return of overseas migrants and visitors, rental demand from overseas arrival tends to skew towards inner city and higher density precincts. So what that means is we're going to start seeing in the cities, units getting snapped up and will rise in rental prices. The rolling quarterly change in rents is now outpacing the rolling quarterly change in housing values across most of the capital cities, which is supporting a rise in gross rental yields. So what we're seeing is in Sydney and Melbourne, we're seeing rents go up as the market tends to slow and soften, which is quite normal. When people stop buying and properties become more unaffordable or hard to buy due to interest rate increases, they start to rent properties. Also, since COVID, with the lockdowns and all the pressures being removed, we're getting those foreign students coming into the major cities and snapping up rentals. So that's quite interesting to observe what's happening in the rental space. Okay, so just in conclusion, at a macro level, housing conditions have been easier since moving through a peak rate of growth in March last year. With the cash rate set to move through a rapid tightening cycle, we expect this trend towards a gradual softening in the growth rate will become more pronounced over the coming months before the national index starts to trend lower. The RBA recently noted a 2% point rise in interest rates could lower housing by 15%, but don't freak out. That is just something that's been thrown out there. The extent of any housing market downturn depends on how high and how fast interest rates rise, but also a variety of other factors will be in play. Labor markets are currently showing the lowest unemployment rate in the mid-1970s, and conditions are set to tighten further. Such a low unemployment rate, along with an expectation of higher income growth, should keep distressed listings at relatively low levels. So it's a bit of a contradiction, but I think that the rate rises will be slow. I don't think that they will be loading them on thick and fast, because that will cause a sharp decline, and they don't want that. And with the low unemployment rate, they can't do it anyway. So it's going to be slow and gradual. So, you know, we've just got to adapt to our conditions, especially Sydneyans and Melburnians. The rest of you guys really don't have to worry about any downturn. Just start using your scripts and dialogues to say, yeah, look, stock levels are still at an all-time low. Interest rates are still at a very, very all-time low. And of course, you know, the unemployment is still at an excruciating low level. So with those conditions combined, it's not going to be a rapid downturn. So just keep milking it and educating both buyers and sellers in what's going on. Of course, the conversation with sellers is going to be a little bit different. It's going to be, let's be cautious with our pricing. Let's price it correctly. Let's remove price. Let's create competition. And feedback is going to be key to getting the desired result and outcome. So mortgage distress should be minimized to some extent by mortgage serviceability assessment at the time of loan and origination. As you know, with the tightening of the credits over the periods, you know, banking, the loans have been harder to get. So that's also going to minimize the mortgage distress that downturns tend to bring. All right, opening it up to the floor. Let's just talk about New Zealand. They're in a full downturn, just so you know, and they have always been ahead of us. New Zealand is showing a 0.8% deficit. Auckland, 1.6% deficit. Hamilton, flatlining. Tauranga, 0.3 deficit. Wellington, 1.5 deficit. The only positive is Christchurch with a 0.5% growth, and Dunedin with a 0.7. But be aware that New Zealand average home price is still $1,035,000, and Auckland is still 1.495. That's $1.5 million average house price. And Tauranga is 1.1, and Wellington 1.1 as well. So, I mean, the growth that they've had is just mind-boggling. But they are showing negative growth rates in most states and territories in New Zealand.